Welcome to the CA class. Today we will be discussing the concept of AS11, effect of changes in foreign currency. Before we get into the standard, let us understand how forex movement moves in the country. Let us say this is India, and let us say you are situated over here. Now, let me say somebody in southern India is buying something from USA through online mode. Let us say he is buying something for $100 at rupees 70 per dollar. So how much money he has to pay to the person in USA? He will be paying 7,000 rupees. So somebody sitting in Chennai, southern India, will be paying 7,000 rupees to a party in USA for purchasing some product from the person sitting in USA. Now let us see how this transaction works. The person in Chennai has only rupees and does not have dollars. The person sitting in USA, he has only dollars and he accepts only dollars. He will not accept rupees. So what happens? We have an intermediary called RBI, where the person sitting in Chennai, will give 7,000 rupees to the RBI to get dollars. RBI will have its own rate for selling dollars. RBI will sell dollars to the person sitting in Chennai. So I will pay 7,000 rupees, assuming RBI is selling at the same market price. I will buy 7,000 rupees. By paying 7,000 rupees, I will buy $100 from RBI and make payment to USA. Now, how does RBI get $100 to sell to me? Now, let us say Mr. Y is coming to India for the purpose of tourism. And let us say Mr. Y is located in USA. Now, when Mr. Y wants to come to India for tourism purposes, he has only dollars. But he requires rupees for the purpose of spending money in India. So what Mr. Y will do, he will sell his dollars to RBI. Now, will the transaction directly happen with RBI? No. There are other agents who are appointed by RBI who will take care of the transactions. But for our example, let us assume the transaction happens directly with RBI. So let us say Mr. Y is coming to India. He is exchanging $10,000 for money at, let us say, 70 per dollar. So he will receive 7 lakh rupees from RBI. So he is giving RBI $10,000 and RBI in exchange is giving him 7 lakh rupees. So what is happening to RBI? When the tourist is coming into India, RBI is collecting dollars, and when money is moving out of India, RBI is giving those dollars in exchange of rupees to Indian people. This is how transactions flow and RBI has control over dollars. Now, what are the cases in which RBI gets dollars? Any foreign direct investment, any tourism in India, or foreign people investing money in India, or NRI remittances. Let's say Indians who are settled abroad earn money in dollars and send the money back to India to their family. So they will send the money in dollars to RBI. RBI will give them rupees and the rupees is transferred to Indian people. So these are few cases in which there is inflow of dollars to the RBI. What are the cases in which there is outflow of dollars? Indian people touring other countries, tourism in other countries. Indian people going for education to other countries. Indian people investing in properties outside India, etc. So now the biggest source of dollar inflow and outflow for RBI is export. Whenever we export goods from India, the US party will pay us money in dollars. So RBI gets dollars and gives us rupees. Whenever we import goods, we have to pay in dollars, like this example. So there is going to be demand for dollars. So there has to be a match between demand and supply of dollars. Currently, we have a fiscal deficit, and hence demand is more than supply. And that is why they keep promoting tourism within India. They keep promoting FDI, non-residents, to send money to India with lower tax rates. They give lower tax exemptions for that. That is why we promote export, and they say don't import much. And they introduce concepts like Make in India, Manufacture in India, promoting startups in India, so that demand for foreign currency is currently more than supply of foreign currency now. We need to equate this, and someday supply has to increase your demand so that we will have enough amount of forex reserves. Currently, the need for dollars, how much we need dollars, is more than the requirement for dollars, and that is why you see dollar rate increasing. This is the background for how foreign currency moves within the country and globally. Now, why is all this relevant for us? This is just background information as to how much within a country we are dependent on foreign exchange movement. Now what we have to do in AS 11, how to account for this foreign currency transactions, is what we are going to see next. In the previous section, we had discussed what is the background for AS 11, why do we have a standard for AS 11, how does RBI get inflow of dollars, and how is the dollars used, how do they balance the deficit. Now, AS 11 broadly covers three areas. First, we will discuss about foreign currency transactions. Second, we will discuss about foreign operations. And third, we will discuss about forward contracts. First, let us see what is foreign currency transactions. Basically, any transaction which involves foreign currency is a foreign currency transaction. Before we get into this, there are a few basic terms which you need to understand. What is home currency? Home currency is the currency in which financial statements are prepared, also known as reporting currency. Foreign currency is any currency other than the home currency. What do you mean by exchange rate? Exchange rate means how many units of Indian currency you have to pay for 1 unit of foreign currency. Next, there is two important definitions in AS 11 known as monetary items and non-monetary items. Very important definitions. What do you mean by monetary items and non-monetary items? Standard defines non-monetary items as those items which are not monetary items. So this is a simple definition. Let us see what is monetary items. Monetary items are those items which are realizable in fixed or determinable amounts in your balance sheet. So look at your balance sheet. Let us take fixed assets, tangible assets, etc. Let us take trade receivables. Let us take inventory. Let us take cash. And then let us take investments. Now, in all these items, if you sell, which one do you get exact book value? Exact book value is realizable. In trade receivables, if it is 100, when you realize, you will get 100 only. In cash, when you realize, if cash balance is 50, when you realize, you will get the exact amount. But if you look at investments, book value might be 500, but when I sell, I will only realize what is the market value. Similar concept for fixed assets, similar concept for inventory. So out of all these, what are the ones when you sell, you realize fixed or determinable amounts? One is trade receivables, other is cash. Similarly, on the liability side, creditors or your trade payables will be fixed or realizable amounts which you have to settle. Hence, investments, fixed assets, inventory will be your non-monetary items. Trade receivables, cash will be your monetary items. Since these have fixed amounts, there is not much of an issue. Items like investments, fixed assets, inventory have so much to do with its valuation, and that is why you have separate standard for investments AS13, separate standard for fixed assets AS10, and separate standard AS2 for inventory to provide guidance on these areas. This is about monetary and non-monetary risk. Now let us proceed to foreign currency transaction. In the previous section, we had run through the definitions of AS11, seen few important terms. Now let us look at what is foreign currency transactions. Any transaction involved in foreign currency. Let us say you are Mr. X, you are buying a product from USA at rupees 70 per dollar and you are spending $1,000. Let us assume this is the transaction happening on 1st of May, and you will make payment for the same after 30 days. Let us say you will make payment on 1st of June. This is the foreign currency transaction. This is the transaction, purchase of goods from a party in USA in foreign currency. How do we account for this in the books? Very simple. It says, first, when to recognize the transaction in my books. I will recognize the transaction on 1st May, date of entering into transaction, at the exchange rate. At what price do I recognize it? At the exchange rate prevalent on the date of transaction. Hence, I am passing a purchase entry. Purchase account, debit, to creditors. At what price I will pay $70 into $1,000. You will pay 70,000 rupees. Rupees 70,000. This entry will be passed on 1st of May. Date of transaction. What is my date of settlement? 1st of June. On the date of settlement, I will pass another entry for settling the transaction. Now, to the US person, you have to settle him on the exchange rate prevalent on 1st of June. Let us say on 1st of June, the exchange rate was 72 rupees per dollar. So how much you have to pay him? $1,000 into 72. You have to pay him 72,000. So on 1st of June, I will do to bank 72,000. However, my creditors account, which I will debit, has only a balance of 70,000 to debit. So where will I debit my balance 2,000 rupees? I will debit my profit and loss account under the head exchange transaction, foreign currency transaction, P&L account, debit 2,000. This will be the entry you pass for a foreign currency transaction where the date of transaction and settlement date does not involve balance sheet date. Now let us make a small change for this example where date of transaction is 1st of March and date of settlement is 1st of May. So in between we have a date called 31st March, which is known as closing date or balance sheet date. So on the balance sheet date, for all my foreign currency transactions, which are monetary transactions, you need to pass another. Let us take the same example. This is the entry I will pass on date of transaction on 1st of March. Now let us assume on 31st March, exchange rate is 71 per dollar. So what the standard says is, you need to restate your liabilities or assets which involve foreign currency on balance sheet date. How will I restate this? You will pass an entry for restating the creditors was 70,000 on 1st of March at 70 per dollar. On 31st March, my dollar rate has increased to 71. So my liability is going to increase by another 1,000 rupees. So on 31st of March, I will pass my restatement entry on balance sheet, which is profit and loss account debit to creditors. I am increasing my liability by 1000 rupees. This entry will be passed on 31st of March. What happened on settlement date of 1st of May? Again, entry for settlement. Creditors account debit 71,000, but you will pay how much? 72 per dollar. So to bank 72,000. The difference of 1,000 will be debited to my P&L. What happens, sir? On 1st of May, if my dollar comes back to 70, then you are saving how much? 1,000. So your entry will be creditors account debit 71,000 to bank. You will be paying only how much? 70,000. So you have a profit of how much? 1,000 rupees, which you will credit to your profit and loss account. So very simple, guys. If the transaction involves a balance sheet date, you will pass a restatement entry on balance sheet date. If the transaction does not involve balance sheet date in between, then you will pass one entry for date of transaction and one entry for date of settlement. This is about foreign currency transactions. Now let us next move to foreign operations. So what are foreign operations? Now, in depth you will be seeing about this in branch accounts, foreign branch. But here let me give you an overview. Foreign operations are classified into integral foreign operations and non-integral foreign operations. What is this? Let us see this with an example. In the previous section, we had discussed exhaustively about foreign currency transactions. Now let us see the next segment, foreign operations classified into integral and non-integral. What do I mean by an integral foreign operation? Let me take a small example. Let's say Reliance in India is opening a new business unit in Africa by investing 10,000 crores. Now, every year, all the profits earned, income is sent back to Reliance head office in Mumbai. It is done such a way that all the profits, cash generated from this business is sent back to the home country. First case. Second example. Let us say Reliance has started a business unit in Africa, but all the earnings in the business unit is reinvested in Africa and not even a single rupee is transferred back to the head office in India. Now, in the first case, when all the income is transferred back to the head office situated in India, then it becomes an integral foreign operation. It is like your operation in India, integral because for reporting of Reliance, income from this business unit in Africa is also essential. However, in the second example, where money is retained in Africa, it is more like an business unit set up here, and this will grow organically into a new business unit, and Reliance will not take any money from here. Second case is a non-integral foreign operation. Why do we distinguish this? The method of conversion of books from here for the purpose of reporting into the holding company, what exchange rate to use for an integral foreign operation and a non-integral foreign operation will vary significantly. In branch accounts, this non-integral foreign operation is classified as an independent foreign branch, and a dependent foreign branch is classified as an integral foreign operation. So we will see some as to how to account for an integral and a non-integral operation, what exchange rate to use when we come to accounting for foreign branches under branch accounting chapter. Next, let us move to how to account for a forward contracts and what is a forward. In the previous section, we have discussed about foreign currency transactions and foreign operations. Now let us see what are forward contracts and how to account for the same. Let us say there is a company called X Limited which has purchased plant and machinery for $1 lakh from USA on 10th of June when the exchange rate is 75 per dollar. So the amount of outflow they have to pay is 75 lakhs. However, there is a credit period of 3 months and hence they have to make the payment only on 10th of September. Now, they do not know what is going to happen to dollar rate in the future and they are worried about it. They are scared that if the dollar rate touches 80 after 3 months, they have to pay something around 80 lakhs and hence they have to pay additionally 5 lakhs. They are uncertain because of the dollar rate in the future. So what they are doing is, X Limited will approach a bank, where the bank will guarantee X Limited by fixing the dollar rate. So they will say that on 10th of September, we will assure you a dollar rate of rupees 77. So on 10th of September, irrespective of what the actual dollar rate is, let it be 80, let it be 82, let it be 85, it doesn't matter. X Limited will pay only 77 per dollar to the bank. So they will totally pay $1 lakh into 77 lakhs to the bank. And the bank will make the payment of $1 lakh to the party in USA. The difference, higher amount or lower amount in dollars, income or expense will be borne by the bank. By doing this, what advantage do I have? For the next 3 months, I need not worry about the fluctuations in dollar rate. I can fix my dollar rate by buying a forward contract from the bank at rupees 77 per dollar. So, this 75 rate on 10th June is today's rate, which is technically known as spot rate, and this 77 today on 10th June I am fixing the rate for 10th of September by entering into a contract with the bank, and hence this 77 is known as forward rate. Now, how to account for a forward contract? This example, protecting myself against the risk in fluctuating in foreign currency, is known as hedging. What do you mean by hedging again? Protecting myself from fluctuating in foreign currency. So I am hedging myself against the risk of movement. So whenever you enter for a forward contract for the purpose of hedging, to protect yourself from the risk of movement in foreign currency, then how to account? They are saying the premium 77 minus 75, excess 2 rupees over spot rate. The premium on forward contracts, premium or sometimes there might be discount on forward contracts, should be amortized over the period of the contract. I am entering for how many months? 3 months. Therefore, for the period of 3 months, the premium on the forward contract will be amortized over the contract. Premium will be given in the question or you have to compute. Second, what if I enter into a forward contract for the purpose of speculation? Speculation means you are not actually purchasing a plant and machinery. You are only purchasing this contract to play with the exchange rate. If the actual exchange rate in the future turns out to be 80, then I will sell this contract to somebody else and make profit of 3 rupees. But if the exchange rate turns out to be 74 in the future, then I will lose out 3 rupees. So speculation, it's a forward contract for the purpose of speculation. What they say is, do not account for any premium or discount on the contract. If the contract involves a balance sheet date, where the contract start date goes through a balance sheet date, then on the balance sheet date, I will mark my contract to the market value. It is called concept of marking to market. What does this mean? What is the exchange rate on the date of balance sheet date? I will account in my books for profit or loss. Let us say you entered for 75, a forward contract for 77. Let us say on the balance sheet date, exchange rate is 76 per dollar. Then what I will do is, I will increase my liability payment by 1 rupee. Meaning, 1 rupee, I will increase my liability. However, if the other way happens, then I will book my profits or losses on the balance sheet date. So, how to solve a sum in this? In the live class, we will be solving one sum in forward contracts for speculation and one sum in forward contracts for hedging to understand how this moves. In summary, forward contracts for purpose of hedging, you will account premium or discount over the contract. Forward contracts for speculation, you will not account premium or discount and you will only mark to market. This is about AS level. We will get more control on this topic when we solve sums in the live class.